Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Shireen Bhan. From Airbnb and Canva to Deliveroo, Instacart, Snap and Stripe, General Catalyst has backed some of the most exciting tech startups of our time. Over 2 decades of investing, over $14 billion invested in over 1,000 startups, the venture capital firm has surely been a catalyst in the American Silicon Valley. But it is early years for the VC firm in India. The portfolio has the likes of Cred and Spinny, both unicorns, and 15 other startups. General Catalyst says they are exemplifying their investment philosophy of ushering powerful, positive change that endures. From healthcare, inclusive finance, climate and supply chain, investing in themes that could turn India into a resilient force in the new world order. And surely, resilience has been the top ask in the past year or so. The economic mellowing has been hard for the exuberant tech industry at large, evident with layoffs, funding collapse, valuation drawdowns and bank failures, as is the case with Silicon Valley Bank. Growth at all costs seems to be passé. Calling for responsible innovation, General Catalyst partners have advised India's entrepreneurs not to replicate the move fast and break things model of founders in Silicon Valley. So even as founders reset their models to adjust to this new world order, a new frontier has emerged, and it is artificial intelligence, a technology that's both promising and could be perilous. Hemant Taneja, the CEO of General Catalyst, who's written a book on AI, says AI changes everything. We need guardrails to survive it, and soon. An India bull and a big proponent of responsible innovation, Taneja, the managing director and CEO of General Catalyst, joins me now to talk about his playbook for the future. Hemant, many thanks for joining us here on CNBC-TV18. Always a pleasure. Before I talk to you about India and AI, I want to get your take on what is happening with the Valley at this point in time, and specifically with the meltdown that we've seen post the Silicon Valley Bank fiasco. Now, you've, of course, been part of the camp that's been supporting a rescue for Silicon Valley Bank. At this point in time, we don't know what course that's going to take. The Wall Street Journal reports that the FDIC has, and I quote, snubbed non-bank overtures as far as Silicon Valley Bank is concerned. So what will that mean, A, the future of Silicon Valley Bank, for the Valley itself, and what this does now to risk appetite?
Shireen, thank you for having me, first of all. I think the Valley is an interesting time in the Valley. First of all, as you know, we've been dealing with a lot of overfunding in the bubble and a lot of companies working through growing into their high valuations. As if that was not enough, obviously we had the recent crisis around Silicon Valley Bank. You know, the reality is that we, in hindsight, just did not have the right treasury management practices for our startups, and you know, relying on a single bank for managing cash for these companies was, in hindsight, a mistake. I think that's going to get fixed. I'm really glad that the ecosystem entirely rallied behind and supported Silicon Valley Bank, because they've been an important institution for us. And I'm also hopeful that we will have 2 or 3 institutions like Silicon Valley Bank that are supporting the ecosystem in the future. I think overall, sort of beyond that, Valley is a euphoric place. I think it's back. There's a huge amount of excitement around being able to use the recent advances in AI as the beginning of the next wave of innovation. And a lot of entrepreneurs are starting businesses there today.
Okay, I'll address the euphoria in just a second that you speak of, Hemant, but let's continue the conversation around the implications and the impact of what's happened with Silicon Valley Bank. As you said, that it will force people to course correct, and that there weren't good enough treasury management practices in place. But, you know, we've periodically been talking about these course corrections. 2008 brought its own challenges to the fore, brought its own set of regulations to the fore, and here we are once again talking about another rescue and another bailout. And the question that then requires introspection perhaps is whether this culture of bailouts, this culture of government intervention and government-led rescue is leading to a moral hazard where capitalism as we know it no longer works.
Yeah, look, I think the issue we had with the regional banks this time was different from the issue we had in 2008, which was really around mortgage-backed crisis. And a lot of the regulation that was created was around making the larger banks robust. However, a ton of that did not apply to these regional banks. So in this last couple of years, with these rapid interest rate rises, their investment strategies, their own treasury management practices were not in tune with how to handle the changing market environment, and I think that's why a lot of this came to bear. So you will find some additional regulation. Problem is, regulation fixes the problem that happened already versus sort of getting ahead of how to think about more resiliency. I think the reality is that as you fast forward 5 to 10 years, you're just not going to have that many regional banks, and you'll see a consolidation in that space. And my hope is that, again, the function that some of these regional banks provide, like the ones focused on the tech ecosystem, that some of that culture and offering is preserved because it's necessary for our innovation economy.
You speak about the innovation economy, Hemant, and, I want to understand from you, given where we find ourselves with the macroeconomic headwinds, with interest rates hardening, perhaps harden even further from where we are today, and, of course, with what's happened with the banks, there was already a sort of risk of how much worse is it today, and what will be the impact of that on valuations, on fundraising, at least in the near term?
Yeah, so look, I think until the interest rates stabilize, and I do think they could go up a bit more from here, you're not going to see stability in the valuations. So every time interest rates go up, you run your DCF models and stocks look more expensive, and you see the market course correcting. I do think what's happening in background is that a lot of the later stage private companies, they are working through those issues, and they're becoming more resilient. They are growing into their valuations. I think you're going to see some down rounds. That's natural, and I think it's perfectly fine for companies to take their medicine and keep moving forward. So I'm optimistic that on the other side of this, sort of, whether it's 9 to 12 months is probably my personal guess. I think on the other side of this, you'll start seeing valuations become more normalized. And you'll also see the IPO market open when we have more stability around the interest rates as well.
Yeah, well, the question, though, is that when does that stability start to kick in as far as rates are concerned? The expectation is that we will see at least one more round of hikes coming from the Fed. But, Hemant, you talked about euphoria, and you said euphoria is back in the valley. It doesn't seem so, though, if one picks up on the headlines at this point in time, with just about everybody laying people off, shutting businesses down. Where do you find the silver lining today?
Look, the same week we were talking about Silicon Valley Bank and all the issues around it, there was also GPT-4 launched, right? I think what you're seeing, if you look underneath the covers of the growth companies where a lot of attention goes, there's a lot of entrepreneurs starting amazing companies right now. And it's happening in and around AI. We think it fundamentally changes the role of software. Our belief is that in all major industries, entrepreneurs are starting to think about how do we bring this technology in to a commercial setting, and we're seeing a ton there. I would say we've probably seen a few hundred business plans just in this year alone, in the last few months, that are around AI, and I am optimistic. I do think this is starting this next wave of really interesting businesses.
Yeah, that's what we've been hearing from a lot of people that we're speaking to. But there are concerns around what this could potentially mean as well for the industry, but more importantly for jobs and for a market specifically here, like a market like ours here in India. In fact, there were headlines just over the last 48 hours talking about how India's 5 million coders could potentially be faced with a AI apocalypse. Is that an extreme forecast to your mind?
Yeah, look, it's a new technology, so the optimists dream about all the good things it can do, and the pessimists think about all the things that can go wrong with it. The reality is, it all depends on what we do with it. And our core philosophy is that if we can use AI to enhance human potential, we can create a much more prosperous society. It's got to be done carefully. It can be headed in lots of wrong directions, and that's why we've written about extensively the need for guardrails around how we use this technology. But all in all, we absolutely foresee a world where it's great for human productivity. It's great for creating more abundance around things that are not as affordable for many around the world. And I do think it can be great for transforming many of the industries that are starting to think about adopting it.
You know, the productivity promise is what everyone is betting on at this point in time. But Hemant, you talked about guardrails. Now, who puts these guardrails into place? We just spoke about the challenge of too much regulation coming in the way of innovation, regulation always being a step behind innovation. So who puts these guardrails into place? I know you're not a believer of the Elon Musk camp that pause things for 6 months and let's first figure out how we deal with this beast before we move any further. And many argue that 6 months is not going to potentially change much. So who sets the rules? Who puts the guardrails in place?
So first of all, I firmly believe that we should never stop innovation. And I think at the same time, we have to do it in a way that we don't repeat the mistakes of moving fast and breaking things in the social media part of this technology cycle. I think the guardrails, to me, are going to be done two ways. One is our technology industry and the way we build companies needs a framework of self-regulation, a responsible AI framework that has the mindset and mechanisms to build these companies in a way that they're positive for society. And the only way to do that is measuring unintended consequences of technology as we bring to life in society. The other is, I do think the government will eventually have a role for how the AI technologies are monitored and regulated. I believe the government is very far behind on having any kind of sophistication to be able to do this. So it's going to come down to a radical collaboration between technology and the policy makers to come up with those frameworks as well. I'm not a big believer in too much regulation, but I'm a huge believer that if we can have the right self-regulation in AI, we'll be able to get the most out of this technology. You know,
when you talk about self-regulation, and that is what many are speaking of as the possible road ahead, you know, given the vested interests and the conflict of interests as well, do you believe that that will pave the way for the kind of future that we want or expect?
Well, I don't think it's enough, but I think it's very necessary in the way we get started. We actually have a responsible AI group coming together in the Valley to create some best practices that all of us can get behind. I think that's a starting point. That is not enough. Nefarious uses of technology are going to happen still, and that's where we're going to need the regulatory frameworks to be able to monitor them. But I do think in the end you need both.